So welcome to Virginia Webinars. This webinar will be focused on the analysis of financial statements. My name is Farid Sadeh, and I'm a consultant with Virginia. You can see my bio up on your screen. I deliver trainings primarily in finance, some accounting, data analytics, and primarily financial modeling and valuations. You can find my bio on the company website. So before we begin, I'd like to gauge our group. I have a poll I would like to administer, and I would just like to ask, have you ever performed financial analysis before? You should see it pop up on your screen. If you can just go ahead and answer it. Great, great. So I'll give you one more moment. If you could please answer the poll. Let's see everyone's experience level here. Great, so it looks like a couple of us have, and we have a few maybes as well. All right, well, maybe's a maybe. You might have done some financial analysis without actually knowing it. So let me just take a step back and give you a little bio on Virginia. We are a financial training company. We have trainings in finance, accounting, data analytics, fraud, and our new vertical, which is leadership and project management. We offer courses for certificates such as the FMI, which I am a holder of, and the Certified Fraud Examiner. We are the only CFE trainer, approved trainer in this region, and we're very proud of that. So if you are interested in pursuing or attending any of these courses, you can find them more on our website. So let's get to it today. So today we're going to talk about financial analysis, or analyzing financial statements, I should say. Now, the first question that we should ask is, what is the role of financial reporting and analysis? What is the purpose of performing financial analysis, right? Well, there's a couple of reasons why. One, there's stakeholders that need the financial information, which we'll get to in a moment. And the other is it's a requirement under the International Accounting Standards Board. This is a body of governance for accounting. So just a little bit of background information there. Now, we mentioned that financial analysis is, it's needed for certain, there's a certain reason why you need financial analysis. And that's basically, it's there to help you make a decision, right? You have your financial statements, you analyze them, and then you can pursue a course of action. Now, who are these individuals or bodies that need the financial information? Who needs access to it? And basically, to put it shortly, or to put it simply, it's everyone. Everyone needs access to financial information, whether you're a board of director for a company or a manager, auditor specifically, an employee, and a current investor, a future investor, a CEO, and a member of the executive team, a tax authority, a customer, a bank, a supplier, whatever. The financial statements are critical to making decisions. They help the users make decisions of what needs to be done in the future. So now that we understand kind of what the purpose of performing financial analysis is, let's go ahead and take a look at what's included in an annual report, right? So when you you receive financial statements, you typically receive them, or you should hope to receive them in an audited form. This is the most trusted form of financial statements. So in your audited statements, you're going to have your annual report, you're going to have your 3 financial statements, you're going to have your notes, your supplementary information, and basically everything you need to know about the company. The annual report basically includes the 3 statements: the income statement, the cash flow statement, and the balance sheet, as well as the statement of owner's equity. This is where you would find the financial information that you will perform a financial analysis on. So moving on, let's discuss the role of the notes, of the financial statement notes and supplementary information. So what are these notes, right? As an analyst, your goal is to focus on the financial statements, right? Well, yes and no. You do need to focus on the 3 financial statements, but additionally, you need to understand what's going on with the company. The financial statements tell you a story, but they don't tell you the whole story. So in order to understand the entire story, you need to refer to the notes embedded within the financial statements. And these notes include things like disclosures of the accounting methods, such as the treatment, for example. This is just a one-off example, but the inventory management. Do they use the LIFO or FIFO method of accounting? LIFO being last in, first out, and FIFO being first in, first out. Now you might think, why does that really matter what method of inventory they're using? But this is actually a very important factor, because it will factor into your cost of goods sold. It will factor into your balance sheet accounts. This is a very important distinction, because as costs increase, it would benefit you to use one versus the other. As costs decrease, it will benefit you to use one over the other. So these are the kind of things that it would assist you with. The other thing are estimates. Management will typically provide estimates in their financial statements, such as how and why they use provisions, for example. Also, they have assumptions that they will provide in calculating again, some provisions and all of these other things within their business, right? So the supplementary information will basically give you the details of what your financial statements are telling you. So when you're performing financial analysis, it's not simply looking at your financial statements and that's the end of story. No, you need to look into the notes. You need to read the notes. You have to understand the accounting methods. You have to understand the methods of depreciation, the methods of valuing inventory. Any major events that have happened, these things all incorporate greatly into your financial statements, because your financial statements are basically telling you a story. So in order to understand the details of that story, you need to read and dig in through the notes. If you're trying to analyze a company only by reading it, by looking at its 3 financial statements, you are not completing your task at hand. In fact, you're probably only performing 25% of what needs to be done. You need to really dissect the statements themselves and understand why there were period-to-period changes, why revenues went up, why fixed assets went down. Was there a change in the depreciation method? All of these things are part of the story, and they help you understand the business. So let's just spend a little bit more time on our audits. Let's just spend a little bit more time on our types of audits. So I know we're spending a little bit of time on the statements and the audited statements themselves, but this is the audited statements they are where you will find your financial statements. So So you need to understand everything that's within the audited financials. Like I mentioned earlier, skipping ahead and just reviewing your 3 financial statements isn't enough. You need to dissect the 3 statements and dig into the notes and really understand what's going on. So there's a few types of audits that companies can, that companies will perform, will have to perform. So there's an external audit, which is the one as an investor you would care most about. This is where shareholders receive the annual reports and the audit of the statements as of year end, for example. These include things like transactions, any major transactions such as an acquisition or the sale of a business unit, estimate, any of the estimates such as their inventory management system, their depreciation methodology, so on, and whether they adhere to IFRS or GAAP. There's another method of an audit, which is an internal audit, which is, as it says, is for internal use. It's for the executives of the firm or the company to understand what's going on with the business. Now, they might not need all of this information. In fact, if they're, as a management team, they probably already know what's going on, but they still need they do still need an audit of the financial statements. So there's 2 more types of audits I'd like to cover. The first one being a government audit, and basically this is any audit that would be provided to any type of government entity. This is basically to provide assurance and adherence to any policies and procedures. This could be to, for example, in the US, the SEC. In this part of the world, the Middle East, in Saudi, it would be to the CMA, for example, the Capital Markets Authority. So these are 2. This is an additional type of audit that is less advertised, I would say, but it still exists, right? And finally, this is the audit that everyone knows about. It's the tax audit. This is to ensure that the financials and the taxes that have been paid to the authorities are accurate. So this is the audit that every company does. They provide financials for taxes at the end of the year. In the U.S., it's very prominent. It's a very prominent exercise, and individuals have to perform it as well. In this part of the world, it's less common, but just so you're aware, tax audits are the 4th type of audit. So I have a question I want to ask. I just want to assess, your thoughts or where we stand. I have a poll I'm going to launch. I would just like to see what everyone thinks. So a clean audit opinion is called what? Now, I know I mentioned that this is not an accounting course. We're not going to be discussing all of these audits in detail, but I just want you to understand that there is a certain amount of accounting that needs to be understood, and there's a certain amount of proficiency that analysts need to hold. So if you could go ahead and answer the poll, let's see what you think. Okay, all right, great. So it looks like the 2 answers that were chosen are unqualified and qualified. It seems that most people chose qualified, while 1 person chose unqualified. Let us see what the answer is. The correct answer, guys, is actually unqualified. I know this sounds kind of, backwards, right? If it's unqualified, how does that make it clean? But the unqualified audit is when everything is presented fairly and the cash flows are in conformity with GAAP. So basically, the unqualified opinion is the clean opinion. The qualified opinion is the next level. It's when most things make sense. However, the audit is not fully clean. There's a couple of exceptions, but they don't invalidate the financial statements as a whole. Now, there's 2 that you do not want to see. So the 2 that you don't want to see are the adverse and disclaimer. The adverse is basically, if you see so when you're looking through your financial statements, right? When you pick up a company you want to analyze, and the very first thing you should do is see what the auditor opinion is. If it's unqualified, qualified, adverse, or did they give a disclaimer opinion? If it's unqualified, you know that the financial statements are clean, they're good to go, and everything follows as far as accountants know, generally accepted accounting principles. If you see qualified, then you should be a little bit worried, but not to the point that you don't want to trust the financial statements. Now, if you see an adverse opinion or a disclaimer, this is when you should probably put the financial statements down and take a step back, because most likely the items presented in these financials are not how I should word this. You should be scared. Let me just say that you should be worried. Most likely the financial information that you're seeing is not accurate or could be grossly misrepresented, and when you see these, the issue is like you will typically, in reality, in practice, you will typically not see adverse or disclaimer, because typically if a company is performing these types, if their accounting is this weak, I should say, they will typically try to change their auditor. Okay, so the brand name of the auditor aside, they will typically allow the auditor to perform the full audit. They'll provide all the information they can, and they'll let the auditor present whatever is accurate, because they companies are aware that if they actually issue an adverse or disclaimer opinion, then as a public company, that could potentially tank their stock price, because their financials are not fully representative of what's going on in the company, right? So this is, I know that I said we aren't going to dig into the accounting too much here, that we're looking more at the analysis, but this is probably one of the most, if not the most important thing that you should look for when you begin your process of analyzing any sort of financial statements. You should always look to see what the auditor's opinions are. What did the auditor say? If they gave an unqualified opinion, then you know that whatever you're looking at, whatever is presented in the financial statements, is probably can be treated as accurately as you can. If it's qualified, then you might be a little bit hesitant, but it's not so bad, right? If you see an adverse or disclaimer, then you probably just want to run away, or look at everything, look at all the information provided with take it all with a grain of salt. So now that we understand the types of financial statements and all of these things, where can we find our audited financial statements? Well, now I'm currently based in the UAE. In this part of the world, in the GCC specifically, each government, each country has their financial statements, has their public company financial statements presented on their website. So in Saudi Arabia, it's under the title. Abu Dhabi is the adx.ae. In Dubai, it's the dfm.ae. And you can see Bahrain, Kuwait, Muscat, and Doha presented above on the screen. In the US, it's actually presented, you can find all financial statements presented on the SEC website. So if you're looking for any publicly traded company, you will find their financial statements on these websites. For a company that's on the exchange of in one of these countries. So now that we understand our financial statements, we understand where to find them, we understand what the auditor's opinion is and what makes it so important. Let's begin our analysis, yeah? But hold on, we have several key questions we need to highlight before we begin our analysis. So let's say we found our company, okay? Let's use an imaginary company. Let's use the Virginia Telecom, okay? We have a company called Virginia Telecom, and it's a relatively new business, okay? And we want to analyze the company's financial statements, okay? Let's say it sells telecommunications equipment globally, and it's a publicly traded company. So let's, what are the key questions that we need to highlight before we begin our analysis? The first question is, it should be at the top of your head, which is, what is the purpose of this analysis? What am I trying to answer? So basically, what are you doing with this analysis? What's the information going to be used for? Are you performing this analysis because you want to optimize a company's capital structure? Are you trying to grow sales? Are you trying to cut costs? Do you have an excess of employees and you're trying to perform an analysis to determine how many employees you need to have? Are you going to create projections? Are you building a business plan, a financial model? Okay, these are the things you need to keep in mind before you begin any sort of analysis. Are you performing a due diligence on the company? Are you trying to figure out what its quality of earnings will be? Are you trying to normalize the quality of earnings? Are you trying to normalize working capital or the cash flows? This is the highlight, and this is what you need to keep at the forefront of your mind, because as you do this, this will allow you to focus on what actually matters and what doesn't matter to your analysis. Okay. The next thing is, which builds on the first, is what level of detail will be needed to accomplish this purpose. So, for example, if your goal is to maximize sales, if you've received a business plan and you're creating a financial model that you want to grow the business, and everything, for example, off of Virginia Telecom, the made-up business that we were just discussing, if Virginia Telecom is driven by units sold or telecommunications equipment sold, then we want to maximize, and our goal would be to maximize our units sold. Now, the question we need to ask is, do we have details into our units? Do we have how many physical units that we sold over the historical period or the projected period, or we're expecting to project? Do we have an average price per unit? Do we have different levels or grades of what we're selling? These are the things that we need to incorporate. For example, if we are planning to build a new warehouse in order to cut costs, maybe we don't want to. We're analyzing this company because we have been renting so much. We have spent so much on rent expense to warehouse our equipment that we will be selling. Maybe we don't want to do that anymore. We need to do a cost-benefit analysis to understand whether it would be, or to assess whether it would be, more feasible to just create, to create a warehouse. We will need the details of the warehouse. How many units can the warehouse hold versus what is our cost per unit that we're currently facing? Next, what data do I have available? Again, will I actually be able to get these numbers? So just because I want to base my projections or I want to analyze my historical information on units sold, will I actually be able to get the units sold? Will I be able to get the average price per unit? Will I be able to find out exactly what the average salary was per class of employees? These are all limits to what, to where we can perform our financial analysis. So beginning with, what am I trying to accomplish? What level of detail do I need? And finally, will I be able to actually get that level of detail? Will the management give me the detail that, the data that I require? Can I find that information? Otherwise, you need to take a step back and reassess what you're actually going to, how you're going to be able to perform the financial analysis. So next, what are the factors or relationships that will influence analysis? Okay, what is going to influence my financial analysis? Will an increase in costs actually, will an increase in the expected costs increase my projected units price? What are these factors that I need to incorporate into my analysis? And finally, what are the limits I will face? And how are they going to hinder my analysis? So, again, this question, your limits, is going to tie back directly into what the purpose of the analysis is. So, going back, if your goal is to perform a cost-benefit analysis, you want to understand whether if it makes more sense to keep leasing space to hold your inventory or to house your inventory, or to construct a warehouse to house your inventory. What are your limits there? Well, can you actually get the contracts? Can you get the leasing contracts from the company? If it's a public company, most likely your limits are going to be access to information. If it's a private company and you're working directly with them, so for instance, if you're performing a due diligence or if you're assisting them with their business plan, these are the things that you should be able to get from management. Now, again, the whole purpose of financial analysis can be used for literally anything. Okay, it can be used to taking a step back here. It can be used to maximize revenue. It can be used to optimize a capital structure. It can be used to understand whether the merging of two companies is better than the two companies being standalone entities. Financial analysis can be used for valuations. It can be used for optimizing your capital structure. When you optimize your capital structure, you're also optimizing your discount rate. So when you optimize your discount rate, you're increasing the value, or you're maximizing the value of your company. So the financial analysis is actually commonly used. You're using it all the time. If you work in finance, there's a great chance you're using financial analysis in your day-to-day in your day-to-day work, and you're not even realizing it. So if you're a credit analyst, you're 100% using financial analysis. If you're a due diligence analyst, you're 100% using financial analysis. If you're an investment banking analyst working on mergers or acquisitions, you are definitely using financial analysis. If you are any sort of financial consultant or auditing consultant, you are using financial analysis. Auditors use financial analysis. It's such a broad term, or such a broad it's such a broad role that it really encompasses so many different sub-industries within finance and accounting. As a trained modeler, I use financial analysis whenever I work with a client to project their business. So as a modeler, my main goal of using financial analysis is to assess what the company can do in the future. I have a historical basis. I've analyzed their historicals. I know what the units, what the actual price per unit that the company sold that their sales were at, and I know what the volumes were, and I have a pretty conservative growth rate that I'll be applying for the future, and my costs. I have all of the information I need in order to create a detailed forecast for management. So these are the things that I would be looking at as a financial consulting, as a financial consultant performing my financial analysis. So let's discuss the framework. This is the framework of what every financial analyst needs to keep in mind before they begin and as they work through their analysis. So the first thing we need to do is state the objective and the context. So we need to determine exactly what the purpose of our exercise is. Okay, so again, if we're trying to maximize cash flow, we need to keep in mind that our goal is to maximize cash flow. If we are trying to optimize our capital structure, we need to keep in mind that we need to maximize our capital structure. So we need to keep in the front of our heads, or the front of our minds, what our goal is, because we can kind of roll off into different areas that have nothing to do with what we're doing. For example, we could, if our goal is to maximize our cash flow, focusing, for example, on our taxes, or our tax rate doesn't really provide any benefit. It might provide a little benefit, but it's not going to provide a complete benefit to our goal. So the first thing we need to do is state our objective and its context. So how the information needs to be presented and how much time we have available to perform analysis. If we have a week, we need to ensure that we can get everything done within a week. We need to plan out. So step one essentially is planning. Step two, we need to gather our data and any other information that we can get. So this is when we would speak to management if it's a private company, or find whatever supplier or customer info that we can find if it's a public company. This is where step two would be essentially data gathering. This is when we set up our calls. send out our questions lists, our IRLs, our information request lists, and so on. The next thing we would do is process data. We'd make any adjustments to our financials. We would analyze our data. This is where we would calculate our ratios. We'd convert our balance sheets to common size. We'd analyze our year-over-year growth in revenue, our year-over-year EBITDA growth. We'd break out everything. And step 3 is probably where most of the work goes. And this is really the grinding part of the process. This is where you're doing all your ratios, you're calculating your ratios, you're calculating your metrics, you're really painting your story, right? So if step 2 was getting your questions answered or having your story be given to you, told to you, step 3 is actually proving it. So this is where you would actually be able to assess whether the story that you were given makes sense or not. And now we have step 4. You'd analyze and interpret the data. So you use the data or the results of your data, and you would see whether if it answers the question that you are trying to answer. So if your goal was to optimize cash flow, has the data that you've computed, does it answer, can you optimize cash flow now? Can you maximize revenue, whatever the goal is, okay? And going into step 5, we have our report, our conclusions, right? We basically relate our investment analysis and recommendation. This is essentially our conclusion. This is what we would report back to management or whoever is going to be seeing the analysis. So if it's your manager, this is where you would report your findings to your manager. And finally, we update our analysis and we repeat the steps when there's any changes. So for example, this is a very common occurrence, but if you work in due diligence and you've completed all of these steps and you've reached step 5, you've reached your conclusion, management might have just finished updating their balance sheets and they want to provide you the most recent information. So you're going to have to go back and incorporate all of that information again from step 2 down. So if there's updated information, you're going to, you've already reported your conclusion and recommendation, you're going to trickle back to step 2, and you're going to go ahead and pull the information, and then you're going to process the data, then you're going to interpret the data and see if your recommendation still makes sense, and then you're going to go back and redo the work. So in order to save you time, I just from personal experience, I recommend really focusing on step 2 and getting complete information, because otherwise you're going to spend a lot of time repeating steps. So after, now I want to take a step back before we dig into our actual financial analysis and how it's done. I'd just like to take a step and just discuss our financial statements really quickly. So if you attended our webinar with us last week, my colleague Ayman Sadet held a wonderful webinar on the 3 pillars of finance. His entire webinar was on these 3 pillars, but I'm going to provide just a quick brief of the pillars and how they relate to our financial statement. So essentially, our 3 pillars are our operating, our investing, and our financing activities. These activities, if you have any sort of finance or accounting background, are on your cash flow statements. These are the 3 pillars, or the 3 main objectives of what a business is supposed to do. Their operations, they have operating activities, which is where their revenues, as you can see here, which is essentially the first part of their income statement, links to. Then they have their balance sheet activities, which is where our non-current assets and liabilities link to. And then we have our financing, which is where our non-current liabilities and our equity section link to. This is sort of how our financial statements are integrated. So we have our operations, we have our beginning with our income statements, we have our sales, we reduce our costs, both cost of goods and our operating expenses, then we arrive at our operating income or operating profit. In other words, EBIT, right? Then we add any other income or any other expenses, and we arrive at net income. After that, moving to our operating section of our cash flow statement, net income flows right into there, and we add back any non-cash items, and we adjust our working capital, which is both under our balance sheet accounts, under our current assets and current liabilities, and we arrive at our operating cash flows. Then we have our investing activities, which is essentially our non-current assets, and we apply those. So if we've bought any buildings, if we've built a warehouse, we'll see a cash outflow here. Then we have our financing activities. Our financing activities to fund our operations and our investments. Our financing activities will be right here. They'll be either, so there's two ways to finance anything. That's either through debt or equity, and any sort of hybrid instrument if you wanna complicate it a bit. But this activity is linked directly to our non-current liabilities, such as our long-term loans and our capital. So this just a quick brief on our financial statements. So moving to our cash flow statements, which is a really important, if not the most important, one of our statements. It will reflect all of the activities between all of our activities for the operations. This includes anything under our operating activities, our investing activities, and our finance activities in that order. Our operating activities, again, being linked to the main operations. This is anything where cash collections from customers or salaries paid to employees would be incorporated. Any interest that the company would receive on debt that it's lent out would be received here. Any taxes paid would be here. So anything operations focused would be again under the operating activities. Moving to the investing activities would be where our fixed assets will be reflected, whether we're buying a building or we're buying a piece of equipment. This is where it will essentially sit. And we also have our loans, whether we borrowed or repaid our loans. It will be, you can find that information here under our investing activities. And then finally, we have our financing activities, which is, investing activities for our loans we've made, I should say, I'm sorry. And moving to our financing activities, this is where we would actually borrow or repay loans that we borrowed, and any equity or dividends that we're paying to our shareholders. So if we have a new shareholder, for example, we could issue equity to them, and this is where the cash flow will be reflected. And if we're going to pay back any dividends, our activity will be represented here, and our cash outflows under financing activities. So moving on, I have a quick question. I have another poll I'd like to ask. If you could only choose one financial statement to assess the financial health of a company, which one of these statements would you choose? So if you guys could please just go ahead and take a vote. Let's see what everyone thinks. All right. It sounds like everyone's been listening. We got 100% for the cash flow statement, and that is absolutely correct. Now, I just want to state that both the income statement and the balance sheet are extremely important. They are the financial statements together. They paint the picture of the company, right? If you had no information, but if you could choose one thing of everything, whether you're having a Q&A session with management or picking one of the financial statements, I would pick, you should be picking the cash flow statement, because this will reflect the actual financial health of the movements between the balance sheet accounts of the company. It reflects what's actually happening, right? So the income statement might reflect that you have $1 million in sales, for instance, but it's not going to tell you if you've received the cash for that $1 million. And if we know one thing in finance and accounting, it's that cash is king, right? The most overused phrase in the industry. And cash is king because cash will keep a business alive, whereas accounting profit will not, right? Companies can go bankrupt for having tons of sales but not collecting any cash, but companies with healthy cash and low sales can stay alive, can survive, I should say much more. So the income statement is important. the balance sheet is important, the equity statement is important, questions, Q&A sessions with management are all equally important, but the most crucial or critical financial statement or aspect of the business to look at is the cash flow statement. This will tell you what's actually happening. Now, if you're not able to get, I would just like to elaborate on this a little more. If you aren't able to get the cash flow statement of the company, and you still want to check the financial health of the company, there's another method that you can use to do that. You can create your own cash flow statement. It's not that hard. Now the cash flow statement represents essentially the cash movement between accounts, right? It's a period over period movement. So it covers a start to end date. Now, the income statement also covers a start to end date. However, the balance sheet does not cover a start to end date. The balance sheet tells you what the accounts values are at a certain point in time. So creating your own cash flow statement is relatively easy or straightforward if you have two balance sheets. You have the starting and ending period of the period you're trying to assess. So if you're able to get your hands on the balance sheet, on two balance sheets, I should say, then you can essentially create your own cash flow statement and and do it that way. But yeah, again, the cash flow statement is the most important statement because you will need to assess the financial health of a company, right? So let's just take a quick look at the relationship between our statements. Now, this is just a quick refresher. You guys sound like experts, so I'm not really going to spend too much time here, but let's just discuss those how the statements are integrated, right? So between the income statement, net income on the income statement it links directly to our equity statement. Our equity statement being the equity portion of our balance sheet. Okay. Our net income also links to the top line of our cash flow statements. This begins our cash flow from operations. After that, we have a couple of items on our income statement, our interest expense and our depreciation and amortization, which are also reflected or linked, I should say, directly to our balance sheet. Our interest expense is calculated based on our debt on our balance sheet, and our depreciation is based on the fixed assets we have on our balance sheet. Okay, so now we've covered those. What else? How else do these financial statements link? Well, for one, a really easy one is our ending cash flow statement. Ending cash on our cash flow statement is the cash balance on our balance sheet, right? Everyone knows that. What else? Let's take a look. Well, what about working capital? Well, working capital under our cash flow from operations, right, is just the movement of our period-to-period balance sheets, the working capital line items on our balance sheet. So, those cover the majority of the items. I'm sure I'm missing a few, but off the top of my head, those are the key accounts and the key movements between the three financial statements. Now that we know that, let's discuss our financial analysis. So, what are the tools we're going to use to construct our financial analysis? And that is ratio analysis. So what is ratio analysis? Ratio analysis are essentially, they provide indicators of a company and how the units are performing. So they're tools, they're diagnostic tools that help us to assess the health of a company. They are the storytelling tools that we use to perform our analysis. We can line up our balance sheets, our cash flow statements, our income statements. We can line them up and standardize them, but we need tools to perform our analysis, and we will be performing our analysis with ratios. Ratios help us identify, in sort of a one-to-one, visual representation of what's going on. Okay. They help standardize things. So how do they help us? How do they help investors? How do they help people performing or analysts performing financial analysis? Well, they help us measure the relationship between the numbers. We can actually understand in standardized form using percentages, essentially, because that's what ratios are, in a sense. They're percentages. What is going on with the health of a company? What's going on a period-to-period assessment, or what's going on, what's the difference between, in relation to another company. So if you're comparing two companies, if you're trying to understand or assess whether a merger of these two companies are better off together or standalone, or whether you want to invest in one company or another, ratios allow you to basically simplify and standardize things. Depending on what the business does, of course. So interpreting your ratio analysis. Now, whenever you perform analysis, you always need to ask yourself these questions. These are the most important questions that we believe you need to ask yourself. Now, whenever you're analyzing a company, you need to have a second company to base it on, whether it's a comparable company or if it's an industry standard. So if you're analyzing Virginia Telecom, for example, you should be comparing it to itself. Yes, definitely, the year-over-year changes, the period-to-period changes, and its health, which we will get into. We will discuss our actual ratios coming up, but you should also always compare the company to another company or an industry standard. Looking at a company or the ratios in isolation do you no good. They will not benefit you in any way, because just because one company is growing 20% a year in revenue, for instance, does not necessarily mean that's a good or bad thing. Because if the industry average is, I don't know, something 75%, then that 25% is really not that great. So again, you have to really look at things in perspective. You have to put things in perspective. You can't just assume that one investment or one company is automatically good. So what are some limits? Sorry, continuing on our interpretation. What are the questions you need to ask yourself? So do the company you're analyzing to the industry average or what it may be, are they actually comparable? Do they have similar accounting practices? Is one accelerating its appreciation faster than the other? What about the divisions? Can you actually compare? Are the two companies comparable? Is the company you're looking at, that you're analyzing, is it comparable to the industry you're trying to analyze it? For example, McDonald's is technically a fast food restaurant. Now, if you actually dig into its financials, you will realize that McDonald's is not really a fast food restaurant. It's more of a real estate company. So does it make more sense to analyze McDonald's to fast food chains or real estate companies? I'll leave that to you, but this is sort of where your thinking needs to be when you're analyzing companies and performing financial statement analysis. You need to understand you have to understand where this company you're looking at is in context to the broader market. So do the ratios that you're using, do they give you consistent readings, or are they jumping all over the place? If, for example, if the company you're looking at is borrowing and repaying, in full amounts every single year, to twice that of its equity, then it's, this ratio is probably meaningless, or it could, hint at something far greater than, what's just on the face of the balance sheets. And finally, do the ratios yield reasonable figures for the industry? Again, this is where you benchmark your analysis, your step 5 of your process, to what's actually going on. Now, there are limits, of course, to everything, and there are limits to ratios. Now, we've kind of already discussed these, but let's just highlight them really quickly. And those are, for one, of course, as we just mentioned, ratios are not useful when they're viewed in isolation. You should always have something you're comparing to. Whether you're analyzing the company's forecasts or projections, you should compare it to the historicals and use those as a benchmark. Or if you have projections of other companies or the industry, you should also benchmark it there. Another limit is the accounting treatments, of course. If when you're looking at companies, this is why you need to read the notes, because you need to identify what the accounting treatment is. If the company is using a FIFO or LIFO method, and we might be in a period of great inflation, which will increase our costs, and suddenly the methodology matters. It really matters. Another thing is you need to. It's difficult to find comparable industry ratios when you analyze companies that operate in multiple industries. So you might have to do a segment analysis. You might have to break up the company and analyze each individual portion of its business and compare those in isolation. and you cannot make any conclusion on one set of ratios. They always have to be used. Again, our financial statements are only telling us a story. So the whole process, the whole financial statement analysis process it's a long exercise. It's not something that can be done quickly. You need to understand the business. You need to understand, well, first you need to have your goal up your head, at the forefront of your head. You need to understand the business itself. You need to really process the data and analyze it. What do you categorize under EBITDA? What is above EBITDA? For example, one thing that always comes up, no matter what you're doing, is other revenue. Is other revenue going to be categorized above EBITDA or below EBITDA? Now, that's the question that you need to understand the business. You can't just throw it in, above or below. You can't just throw it above or below just for the sake of it. Can everyone hear me? Can everyone hear me? Can you just, I'm sorry, I may have gotten disconnected. You can hear me? Okay, great. Great, thank you. So yeah, so these are all questions you need to ask yourself, and these are the limits essentially. Now, I know we're coming up on time, but there's a few things I just want to highlight. Now, there's a couple of types of analysis, which we've kind of already discussed in detail, but there's essentially, we have two types. We have trend analysis and cross-sectional analysis. Trend analysis is when we're analyzing a company year over year. It's essentially the year over year analysis. Okay? We're analyzing the period to period growth or decline or whatever it may be of a company in its financial statements, whereas cross-sectional analysis is when we're analyzing our company to another company. Again, you should always be using both. For instance, if you are a credit analyst, you should be looking at the year-over-year changes in obviously all the credit metrics that you would need, such as debt to equity, debt to assets, your interest coverage ratios, and so on. But you should also be looking at the comparable companies that operate in the same industry and assess their health. So when you're a lender, for instance, you probably wouldn't, you would probably lend up to the point of the industry average. So you probably have, for companies operating in industry X, a certain level of EBITDA, debt to EBITDA that you require, a certain ratio you require your company to have, and these are the things that you would incorporate in your analysis. So just moving on a bit, we have a horizontal analysis and we have a trend analysis. So horizontal analysis, just like we said, it's when you're looking at things over time. Think about it as year-over-year analysis. Now, our trend analysis is a sort of horizontal analysis, but it's where we're analyzing a base year to the projections. So we're using for instance, if we're trying to understand how our revenue growth will be from 2020 in comparison to our projections, then we would use 2020 as a base year and maybe perform a trend analysis every year based on 2020. So we're trying to see what the total growth is in revenue, for example, for 2021 versus 2020, 2022 times 2020, and so on and so forth. So we want to see the trend. Is it consistently growing, or and we want to see when it would actually slow down. So these are the two types of analysis we would do in practice. You would apply both. You would definitely apply both. When you're performing financial analysis, you really want to do as much in-depth detail and research as you can. There's really, you really don't want to miss anything. So I have one final poll I want to ask. Now, what can we perform financial analysis on? Which, this is, it's a multiple choice poll. So go ahead. Can we perform financial analysis only on historical information, projected information, quantitative information, all of the above, none of the above? Which of these makes sense? Okay, it looks like everyone has chosen all of the above. Yes, technically, yes, that is correct. You can perform financial analysis on historical information, historical financial analysis if you're performing a due diligence. You can perform financial analysis on projected information on a company's projections to kind of assess whether their projections make sense. And any sort of quantitative information, absolutely, absolutely, well done, well done. It seems that these polls are pretty easy. Huh? So now let's discuss these tools. The tools that we're going to use to perform our financial analysis basically fall into several categories. When we perform analysis, we're looking at the following items. We're always assessing the company's liquidity, the company's activity being its operations, its profitability, and its solvency. When you're performing a valuation, you will incorporate valuation ratios, but that's not 100% required. So under liquidity, we're basically trying to interpret whether the company has enough cash to operate. Its activity, we want to assess how it's actually managing its operations. Does inventory sit on the balance sheet for too long? Is the company wasting too much money on warehousing its inventory? Is it not receiving cash quickly enough? What's going on with the operations, right? Profitability, is the company actually making a profit? Is profitability increasing? Is it declining? Where? Why? These are questions you need to ask. Solvency, is the company actually solvent? A company can be insolvent for a short period of time, but it cannot be illiquid, right? Because liquidity is what matters. Cash is king, remember? So if the company has cash, then most likely it can kick down solvency. It can kick solvency down the line. It's not something it has to worry about, but it's but it is something it needs to keep in mind. And finally, valuation. The valuation ratios are just something to keep in mind. This is how you would price your company, whether it's EBITDA per share, price per share, net income per share, which is our PE ratio, price to earnings. You could analyze price to cash flow, and your growth rate. These are the things that you would combine with your traditional valuation analysis, whether it's a relative valuation or your more traditional income approach, your discounted cash flow valuation. Additionally, you would use these metrics when you're performing. Again, when you are performing your valuation, you would apply all of these metrics because you would want to ensure that, or you do your best to make sure that the company you're valuing is actually comparable to the company is actually comparable to the companies you're basing it on. Because valuation ratios, it's a lesson on its own, but would be comparable method would use the multiples of comparable companies, and you'd apply that on your whether EBITDA, revenue, net income, whatever it may be. So I'm just going to skip ahead a bit. There's one thing I do want to discuss. We might go over just a couple minutes, so just bear with me. Our financial reporting metrics, of course, these are the 6 accounts that everything on your financial statements will somehow link to. These are the main accounts, and you'll have sub-accounts within. So assets, liabilities, equity, revenue, expenses. Your equity being your capital, your retained earnings, your revenue, any sales or products that you're selling, your expenses, whether it's cost of goods, salaries, rent, etc. I think these are pretty self-explanatory. You guys seem to get it. Now, just looking at our liquidity ratios in more detail, essentially they're the ability to, they assess the ability for a company to cover its short-term debts, right? And like we discussed, we look at our current ratio, our quick ratio. These are the tools that we will be using to assess the company's liquidity. Moving on to our management and activity ratios, this is what we would use to measure the company's ability, how quickly it's able to convert its assets into cash, right? So is it receiving cash quickly enough on its sales? How much of sales are on credit? These are all things that you would be performing your analysis on. You really, if there's one thing I'd really like for you to take away is you cannot look at anything on a company's financial statements in seclusion. You really have to look at all of your pieces together. You have to really understand the story that's being presented to you. Your financial statements tell you a story, okay? And the only way that you're really going to understand that story is if you combine the actual statements with the ratios. So you can interpret what's going on. Your financial statements are really telling you a story. So the better you can understand that story, the better you can actually analyze a company. Because again, they're not just numbers on paper, they represent things, right? So if salaries go up, that means that the company has either greatly increased salaries or the company has employed many more people. Now its staff has increased. which could indicate that sooner or later they're going to need to move to a larger office. And if they need to move to a larger office, there could be higher rent expense in the future. And that could they could come to a point where the management might decide they want to go and build an office and own it rather than rent it. So all of these things are painting a story that you really need to understand when performing your analysis. Again, for whatever it may be, whether you want to make an investment or you're doing due diligence or you're assessing the credit health of the company, whatever it may be, you really need to understand the story that's being presented. The solvency ratio is just to ensure, again, that the company can pay its long-term debts, that the company can pay what its borrowers. Again, profitability, it's just the ability for the company to generate income for its investors. And these are traditional, these are the traditional ratios, whether the net profit margin, the gross profit margin, EBITDA margin, operating profit margin. You can see where your profit is actually disappearing. So if there's a great disparity between the gross profit margin and your operating profit margin, then you should probably, and you're trying to optimize the company's cash flows, you should probably look at your operating expenses. Now, there's one more piece of information I really need to ensure that we cover. When you're analyzing a company, this is probably the most important. This is the most important tool. This is the most important tool I will leave you with. It's called the DuPont analysis. So, what does the DuPont analysis do? So the DuPont analysis is based on the return on equity, the ROE. The ROE measures the company's return that it can generate on its equity capital. Simply put, it's, as you can see in level 1, it's net income to equity. So logically speaking, we want to maximize our return on equity. We want the highest net income possible with the lowest equity possible. So if you think about it from a logical point of view, you want to put the least amount of money into the business and generate the highest amount of net income, the highest amount of profitability on your operation. So if you're generating $1 million of sales, you want to keep as much of that $1 million of sales as you can, whether you're cutting expenses or operating, keep limiting your however much is being expensed as you can as profit reaches net income. So what the DuPont analysis does is basically it breaks down that return on equity on a 2, 3, and 5 layer on 5 layers. Now it allows you to really understand what's driving the ROE. So as you can see in level 1, it's simply this is a simple version of return on equity. When we break it down to get the level 2 DuPont analysis, we're just multiplying both sides by sales. So what we're getting to is the breakdown of return on equity, which is profit margin times the equity turnover, sales over equity. Okay. When we move to level 3, we are breaking it down even further. We're incorporating our assets now. We can visually see how our assets are affecting our return on equity. So, if our goal is to maximize return on equity, we would either need to increase our numerator or decrease our denominator, or both simultaneously. So net income would have to go up in relation to sales. Obviously, we don't want to decrease sales, so we would obviously want net income to increase. But if we can decrease our assets and increase our sales, that would create a much higher magnifier effect. So as you can see, all 3 of these items are being multiplied against each other. So if we can decrease the denominator and increase the numerator in these, we'll have a much higher return on equity. That is our goal. This is how we can really understand the drivers of the business. Now let's elaborate a little bit more. We are going to just discuss the 5 level DuPont analysis. The 5 level incorporates taxes. This is where the taxes break down. Now in this part of the world, in GCC, you don't really need to focus on the 5 level. You can stop at the 3 level. The 3 level will get you far enough as there's not really any taxes here. Not yet, at least, right? But yeah, in all seriousness, in this part of the world, the 3 level DuPont analysis is the extent of where you would, the DuPont analysis you would reach. In the West and Europe and Australia, you would definitely reach the 5 level. This would allow you to really break down the drivers of equity, of your return on equity, and really understand where your profitability is coming from. So again, these all 5 of these items are creating a multiplication effect, right? So they're multiplying against each other. You want the highest return on equity as you can. So if you can magnify any of these in isolation, then the overall return on equity will magnify. This is how you can really understand what's going on with the business. Okay, so now that we've done that, let's just discuss the market and valuation ratios. We're not going to spend too much time here because we're just about done. Our market, I feel that we would be doing a little bit of a disservice. We wouldn't be covering everything if we didn't at least discuss our market analysis, our valuation analysis. So what do our market and valuation ratios do? They're just assessing the valuation of a company. Okay, so this is what you would use when you're performing a comparables analysis. A comparables analysis, comparables valuations, you would apply these metrics. So you look at the company's price to earnings, its earnings per share, and understand what's going on, its price to book value. Again, this would have to be limited to public companies. You can't really perform these on private companies unless you actually have a transaction. So taking a step back, trying to understand what these are and how we would use them. So basically, step one, you would go through your 6 steps of your financial analysis framework, right? You would understand what you're trying to do. You would gather the data. You would analyze the data. You would understand the story of what's being happened. Then you would make your recommendation, and you'd be fine, right? You would understand your you'd be done with the entire financial analysis process. Now, if you want to analyze, or if you want to invest in a company, or you want to value a company, this is where you would. This would be the next step. This would be after you've done all of that. So after you've done your whole financial analysis exercise, comparing that company to other companies, you could also apply these valuation ratios to those companies and come and reach a fair value or market value of the company. You guys, I know that we've just gone over our time by just a bit. This is all I have for you today. I really appreciate everyone bearing with me. I hope that this was interesting. I hope you learned something. If you've learned anything, I really hope that you remember that financial statements tell a story, and in order to really understand the whole story, you cannot limit yourself to just looking at the 3 financial statements. You have to read the audited report. You have to look at all of the information provided. You have to ask questions, and you really have to perform analysis, not in isolation, but in comparison with other businesses. And the best way, in my opinion, in my experience, to do that is in order to maximize the profitability and value, is to look at return on equity through the DuPont analysis. I hope that this was beneficial to your learning. Again, my name is Farid Sadeh from Virginia. We offer courses on financial analysis, advanced financial analysis, financial modeling, valuations, data analytics, Power BI, Power Query. And if you are interested in any of these, if you're interested in any certificates, please take a look at our website. We also offer trainings for certificates such as a certified fraud examiner. We are the only certified fraud examiner trainer, approved trainer in this region. And we do have a new vertical that incorporates the PMP, the Project Management Professional certification. So if you're interested in any of these, we offer in-person and virtual courses, and we are launching e-learning courses soon, which incorporate data analytics and PowerPoint, Excel, and financial modeling. But if that's all, I appreciate it, and thank you. I'll see you in the next one.